Today we're going to be talking about Google as they are facing one of the most significant antitrust lawsuits in recent history. And there's actually a lot of similarities between this Google case and a 25-year-old Microsoft case. So we will dive into those and what potential outcomes could happen from this case based off what happened 25 years ago. And obviously a lot of outcomes from this case could have an effect on Google's earnings. So we will take a look at their Q3 earnings that were announced around a month ago and discuss some of the changes that could occur depending on what the outcome is of this case. I truly appreciate the support you've been giving the channel in the last month. Thank you guys so much for liking and subscribing and getting these videos out there. It really helps out the channel. Thank you so much. And if you do enjoy the video, make sure to drop a like down below and subscribe for more content like this. On this channel, I like to be as transparent as possible with you guys, letting you know what I'm buying and selling. And here we have the YouTube portfolio. The current value has reached $58,474.52. We are up over $4,000 in the last month. Full transparency, the stock that we are going to be talking about today is Google, and I do own 5 shares of this stock in this portfolio. I own more in a different portfolio. Right now in this portfolio, I do have a cost basis of $842.55. You have to divide that by 5. That comes out to around a share price of $168 per share. Right now, I'm up around 0.5% as this is my newest position in the portfolio. I also own shares of Alibaba, Apple, Microsoft, Palantir, Visa, PayPal, and SoFi. A couple other things to note in this portfolio is I do own shares of SCHD and VYM, which are dividend ETFs. I'm potentially looking to sell out of one of these over the course of the next year to build up my cash position a little bit more and move it into individual stocks. But right now, both of these positions are up around 20 and 25% respectively. I also already have a fairly large cash position sitting at $12,600. So with that out of the way, let's go ahead and take a look at Google. Let's start by looking at their stock chart as they have gone up around 1.5% in the last month. The S&P 500 is up around 3%, so it's actually underperforming the broader market right now, at least on a monthly basis. Over the last 6 months, Google is down around 4%, and year to date, it's still up around 22%, but from its highs of the year of around $192, the stock has actually fallen about 11%. So it's on a little bit of a dip right now. And the main reason for this dip has to do with a case that is being brought forward by the DOJ. They are claiming that Google is breaking anti-monopoly laws, and they're actually now most recently pushing for Google to sell off their Chrome browser. The Department of Justice is calling for Google to divest its Chrome browser following a ruling in August that the company holds a monopoly on the search market. Google Chrome was originally launched back in 2008, and the sole purpose of Google rolling out this application was to allow them to collect more data to run better targeted ads. And the DOJ sees this as a problem as it allows Google to have more of an upper hand over other players in the ad space. And when you think about the ad space, the most critical thing for these companies is data. Google is the #1 generator of ad revenue. You can see that Google alone generates $71.5 billion of ad revenue. The second player is actually Amazon, generating $33.96 billion of ad revenue, followed by Facebook, which generates $28.03 billion of ad revenue, and then Instagram sitting at $23.32 billion of ad revenue. When you think about all of these companies, they all collect massive amounts of data. Google collecting data obviously through search, Facebook and Instagram through profiles and understanding of people and what they want and what they're looking at. Amazon, the same thing. They are looking at the products that you are searching on their website and pushing advertisements to you based off those searches. So understanding data and what people are looking for and what people may be interested in is super important when it comes to the ad space. So when it comes to the DOJ, their most severe proposal is the selling off of Google Chrome. However, they also want a few additional things. They want to prevent Google from entering into exclusive agreements with third parties like Apple and Samsung. This is obviously targeted at Google and how they have made their browser the default browser on iPhones and Galaxy phones. And the reason the DOJ wants to block these agreements is because they are not small sums of money. Back in 2021, Google paid $26 billion to become the default search engine on browsers and phones. When you think about $26 billion, that is a massive amount amount of money, and a lot of the other players in this industry cannot pay that money, so by default, Google wins a lot of these contracts. The thing is, this does not only hurt companies like Google, it also has the potential of hurting companies like Apple, as they are getting a massive payday when Google signs these agreements, because they are earning $15 to $20 billion from Google to make them their default search engine. And that's not it for the DOJ's request. They also want to prevent Google from eliminating emerging competitive threats through acquisition, minority investments, or partnerships. And all of these requests from the DOJ are proposed to last a period of 10 years. So the question that is in the back of the minds of a lot of investors and analysts out there is, how do we exactly price this into Google? And one of the most common things that is being looked at is a case from 25 years ago for Microsoft that is very similar, as it can provide some of the answers on what judges could potentially rule on this antitrust case. In 1999, a federal judge determined that Microsoft had illegally used the market power of its Windows operating system to box out rival browsers. During this case, a judge found that Microsoft had forced PC makers to include its Internet Explorer web browser in Windows, and even threatened to punish them if they installed or promoted other web browsers such as Navigator. And at that time, the judge proposed that Microsoft divest either its operating system business or its applications business. This again is very similar to what's happening today with Google, as the DOJ is trying to force the sale of Google Chrome. And this is where we start to get an idea of what could happen today, because Microsoft was able to successfully appeal this ruling. However, courts did turn around and ban the company from retaliating against device makers for shipping PCs that included multiple operating systems. On top of that, Microsoft was required to give software and hardware companies the same programming interfaces that Microsoft middleware employs to work with Windows. So based on the previous knowledge of this Microsoft case, it's very unlikely that Google will be forced to sell off Google Chrome. The most likely outcome is that Google will be prevented from entering into exclusive agreements. This includes agreements like those with Apple or Samsung that offer their browser as the default browser on iPhones and Galaxy phones. There's no denying that this could have a massive impact on Google's revenue. This would fall under their Google Search and Other revenue category, which made up $49.385 billion in their most recent quarter, which is about 56% of their total revenue, which came in at $88.268 billion. Google doesn't offer a good breakdown of how much of this $49.385 billion is actually made up from the phone market. When you think about Google Search and Other, this not only includes the phone market, it also includes things like if you just go on your computer and start using Google web browser. So it's important to keep that in mind. But one thing that I also want to note here is that oftentimes a lot of people that I know, when they get a new iPhone or Galaxy phone, the very first app that they download is Google Chrome. So if Google is able to maintain Google Chrome, I think that is much more of a win, because a lot of these people trust Google Chrome and use it as their main browser, whether they're on a computer or their phone. So obviously this would have an effect on Google's business, but the question is really how much. And they're experiencing growth in other areas of their business, most notably cloud. Cloud has been a huge grower recently. A year ago, they were putting up $8.4 billion. That has grown by almost 35% year over year to $11.353 billion. And it was a great quarter as a whole for Google. They reported their earnings back on October 29th, and they came through with an EPS number of $2.12, which beat analyst expectations by almost 15%. Top line numbers also beat by around 2.5% as they put up that revenue number of that $88.27 billion. One thing to keep in mind with Google is the volatility of their earnings. You see this across the ad industry, whether it's Google or Meta. A lot of these ad companies really have volatile earnings, especially when the economy goes poorly. Because when the economy goes down, a lot of these other companies aren't looking to spend money on ads. They really pull back on their ad spend, and that obviously has a big effect on Google and Meta. And I think that that's a big reason as to why Apple as well as Microsoft haven't gone after this market more aggressively. This market has very high margins, however, the volatility can be very significant. And we can even see this looking at some of their numbers. For the current year of 2024, there are 48 analysts covering Google stock, and they have an average EPS estimate of $8.01. When you compare that to a year ago, Google put up only $5.80. That is a huge move year over year. And this volatility is why companies like Google and Meta tend to trade at a lower valuation compared to a lot of the other big tech companies. Right now, the forward P ratio for Google is sitting at 19.23. Right now, you are paying over $10 more per dollar of earnings to buy shares of Apple, as it is sitting at a forward P ratio of 31.55. And Google right now is trading at a valuation that is significantly below the NASDAQ 100, which currently has a forward P ratio of 30.85, and is even below the S&P 500, which currently has a forward P ratio of 23.45. Because of this low valuation, as well as their good business performance, analysts currently have price targets that represent upside of anywhere from 15 to 30% in the stock from its current price of around $170 per share. We have analysts at Jefferies that have a price target of $235 per share, and at UBS of $192 per share. So for me personally, I'm not overly worried about this antitrust case. I think there's concerns if the DOJ were to get everything that they're looking for, but I don't see that being a realistic possibility just because we have this previous precedent that was set with this Microsoft case back in 1999, and I think that's going to help support Google's case and probably just result in some restrictions around these agreements that they make with Apple and Samsung. So that's just my opinion. Right now, I'm not really buying. If it dips down to the $160 range, I think I'd look to add a few more shares, but right now I'm kind of just sitting, seeing what happens. And again, if it goes back down to maybe 160 or even that 150 range, I think I'd probably be a buyer again. But keep in mind, as I always say, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. With all of that said, I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, what are turkeys thankful for on Thanksgiving? Check the comments down below for the answer. Thanks for watching.